Every modern economy rests on one quiet assumption: that the price of money is discovered, not commanded. We're told interest rates emerge from millions of savers, borrowers, and investors bargaining over time. In textbooks, the bond market is where fear and greed collide to create a single signal: the yield. It's supposed to be organic, impartial, and free. But what happens when a small group of people in a room decide that number instead? What happens when a central bank doesn't just influence interest rates, it orders them? That is the idea behind yield curve control. Not just nudging short-term rates up or down, but pinning the entire structure of interest rates in place, from tomorrow's borrowing cost all the way out to money due decades from now. So the uncomfortable question is this: if interest rates are meant to be market prices, can they actually be commanded? Or does history suggest there's always a hidden bill to pay when you try to fix the price of time itself? Yield curve control sounds technical, almost boring, like something buried in a policy paper. It isn't. It is one of the most extreme forms of financial power a state can exercise without openly calling it what it often becomes: financial repression. Interest rates are not just numbers on a screen. They are the architecture of the modern world. They determine who can afford a home, which businesses can grow, what governments can get away with, how pensions are funded, and whether your savings quietly grow or quietly die. When a central bank grabs the yield curve and nails it to the wall, it isn't performing a minor tweak. It is rewriting who wins and who loses in the financial system. To understand whether rates can actually be commanded, and what happens when we try, we have to go back to a moment when a great power effectively became its own bond market and decided, for a time, that it would not allow yields to move at all. First, picture the yield curve itself. Imagine lining up every possible loan a government can take, from overnight credit to 30-year bonds, and plotting each interest rate on a graph. Connect those dots, and you get a curve. Usually, short-term rates at the low end, longer-term rates at the high end. That curve is like the heartbeat of the financial system. When growth is strong and inflation expectations creep higher, the curve steepens. When recession looms, it flattens or even inverts. In theory, it reflects the aggregate wisdom and fear of millions of participants. Yield curve control looks at that line and says, "We don't like what the market is saying. We're going to redraw the line and enforce it." The central bank chooses specific rates, perhaps 0 at the short end, a defined level for 5-year bonds, another for 10-year, and promises to buy or sell as many bonds as needed to keep yields locked there. If traders push yields higher, the central bank steps in as an infinite buyer, printing new money to soak up supply. If yields fall too low, it can sell. On paper, it sounds like absolute power. We will meet any size of selling with newly created money. The curve moves only when we say so. For a while, that power looks real. Then, history quietly reminds everyone that markets can be pushed, but not permanently erased. In the 1940s, the United States faced a staggering problem. It was financing a global war on an unprecedented scale. Tax revenues were not enough. The government needed to borrow vast sums, and it needed to do so cheaply. Higher interest rates were not just inconvenient, they were dangerous. Rising yields would make war finance harder, threaten confidence, and potentially destabilize the entire effort. So the U.S. Treasury turned to the Federal Reserve with a simple demand: keep our borrowing costs low. Short-term rates would be pegged near 0. Long-term yields would be capped around levels the government could handle. The Fed agreed. If the market tried to push yields above those ceilings, the Fed stood ready to buy. If yields fell below the target, it could sell. For nearly a decade, the yield curve in the United States was not simply a market outcome. It was a policy choice. On the surface, it looked like a triumph of control. The war was funded. The government borrowed heavily without seeing its interest costs explode. The bond market looked calm, contained, tamed. But fixing prices never makes risk disappear. It only shoves it into a different corner of the system. As the war ended and the economy heated up, inflation began to rise. Under normal conditions, rising inflation would push bond yields higher. Investors would demand compensation for the fact that every dollar returned to them in the future would be worth less in real terms. The Fed, however, had promised that those yields would not rise. So the bond market tried to move, and the Fed pushed back. Each time it defended the peg, it had to buy more bonds and create more money. The more it leaned against the market, the more it fed the very inflation that was testing the peg in the first place. It became a vicious circle. Inflation pressures increased, investors wanted higher yields, the Fed suppressed those yields by printing money, and that printing added more fuel to price increases. Holding the peg was like pushing a beach ball underwater. At first, the effort feels trivial. Over time, the pressure builds. The longer you hold it down, the more violent the surge when it finally slips from your hands. By the late 1940s, the Federal Reserve was trapped between the political demand for low rates and the economic demand for monetary discipline. Eventually, the standoff ended in the early 1950s. The peg was abandoned. Yield curve control, at least in that form, came to an end. Did it work? In the narrow sense, yes. It kept wartime funding cheap and avoided a bond market crisis during a crucial moment. But there was a delayed price. Years of distortions, inflationary pressures, and a painful transition when the illusion of total control could no longer be sustained. The first lesson of yield curve control is simple. You can command rates for a time, but you cannot command what people think and feel about money. Expectations, trust, and fear live outside any committee's direct authority. For decades after that, yield curve control was treated as a relic of wartime finance, something you studied in history, not a tool you casually reached for in peacetime. Central banks preferred a gentler influence. They set short-term policy rates, delivered speeches, published forecasts, and bought some bonds at the margin. They tried to guide markets, not dominate them. Then each crisis pushed them further. In 2008, after the global financial system nearly imploded, central banks cut policy rates to zero and beyond. They launched quantitative easing on a massive scale, buying government bonds and other securities to push long-term yields down. They still insisted the market was in charge, but their fingerprints were suddenly visible on almost every part of the curve. Eventually, some central banks even experimented with negative interest rates, dragging the price of time below zero, defying the intuition that lending should be rewarded, not punished. In that new world, yield curve control no longer looked like a dusty historical curiosity. It looked like the next logical step. If you are already buying huge quantities of bonds, already signaling that rates must stay low for longer, it becomes tempting to simply declare specific yields and enforce them. That is exactly what happened in Japan. By the mid-2010s, Japan had been trapped in a strange economic environment for years. Low growth, low inflation, and seemingly permanent ultra-low interest rates. The central bank had slashed policy rates, purchased government bonds on a colossal scale, and even bought stocks through exchange-traded funds. Yet inflation barely moved, and the economy refused to break into the kind of robust growth most policymakers wanted. In 2016, the Bank of Japan went further. It announced that it would peg the 10-year government bond yield around a chosen level near zero, and would buy whatever quantity of bonds was necessary to keep it there. This was yield curve control in its purest modern form. Selling Japanese government bonds to push yields higher meant facing a buyer with an effectively unlimited printing press, and no risk of running out of currency. At first, the policy looked like a clean success. Yields stayed pinned. Government borrowing remained cheap. Volatility in the bond market collapsed. To many observers, it looked like proof that rates could, in fact, be commanded if the central bank was willing to go far enough and stay committed. Under the surface, the same old trade-offs were silently accumulating. When a central bank promises to buy bonds at a given yield, no matter what, it slowly becomes the market. Over time, the Bank of Japan came to own an enormous share of its government's debt. The bond market, which was supposed to discover the true cost of capital, began to resemble a stage set. Prices moved, but everyone knew the main actor was the central bank itself. This created a strange kind of stability. Nothing much happened, because everyone knew the referee had become the dominant player. Speculators were wary of betting against the peg. Long-term investors adapted to the new reality. But beneath the calm surface, questions built up. What happens if inflation, after decades of dormancy, finally comes back? What happens if global yields rise and investors start doubting that the peg can be maintained indefinitely? How long can you hold that beach ball down? The second lesson of yield curve control emerges here. You can pin rates to a number, but you cannot pin reality. When the economic tide shifts, the peg itself becomes the target. The longer it has been in place, the more violence there can be when it breaks. Other countries flirted with the same strategy. In the early 2020s, as the pandemic froze economies and triggered a wave of panic selling in financial markets, another central bank chose a specific maturity on its curve and declared that it would keep that yield fixed. Investors believed the promise. Yields stayed where they were told to stay. For a time, it looked effortless. Then recovery came faster than expected. Inflation pressures began to appear. The yield that had seemed comfortable during crisis conditions suddenly looked artificially low. The central bank faced a brutal choice: defend the peg by buying more bonds and risk losing credibility on inflation, or abandon the peg and allow yields to jump. Eventually, it stepped back. The guaranteed yield was no longer guaranteed, and anyone who treated that promise as unbreakable learned in real time what it means when control gives way to reality. On a whiteboard, yield curve control appears elegant. Fix the cost of government debt, provide certainty to businesses and households, calm markets, avoid sudden spikes in interest payments. In the real world, it operates as a quiet wealth transfer machine. When a central bank holds yields below what a free market would demand, several things happen at once. Governments are able to run larger deficits at cheaper rates. Highly leveraged borrowers, big corporations, property developers, financial institutions benefit from ultra-low financing costs. Meanwhile, cautious savers, retirees, pension funds, and anyone relying on supposedly safe bonds see their returns crushed. It is a modern version of something very old, using the machinery of the state to move wealth from those who save patiently to those who borrow heavily. It rarely appears on a ballot. It is not discussed in the same way as a tax increase. It functions through suppressed yields and often inflation that creeps higher than those yields over time. The numbers on your account may rise slowly, but the purchasing power behind them erodes. The trick is subtle. Savings are not confiscated in a dramatic overnight act. They are quietly weakened year after year in an environment where interest rates are held down by policy and the cost of living continues to climb. From the outside, yield curve control can look like stability, calm bond markets, predictable borrowing costs, reassuring statements from officials. From the inside, it can feel like a slow draining of real value from those least equipped to game the system. Can rates be commanded? In the short run, yes, history is clear about that. A determined central bank, backed by political support and a compliant financial sector, can hold down yields for years. It can threaten speculators, buy vast quantities of bonds, and convince investors that fighting the peg is pointless. Under the right conditions, the illusion of omnipotence can last a long time. The longer it lasts, the more fragile the underlying structure can become. Interest rates are not just prices, they are signals. They tell the truth, however uncomfortable, about growth prospects, inflation risks, and the demand for capital. When those signals are suppressed, the system starts making decisions based on a distorted picture of reality. Projects that only make sense at artificially cheap borrowing costs get funded. Governments grow used to debt loads that would be impossible under honest rates. Investors assume that the central bank will always be there, always ready to rescue markets if something goes wrong. Reality has its own schedule. At some point, inflation rises beyond what policymakers can tolerate, or foreign investors demand higher compensation, or political pressure turns against endless bond buying. When that moment comes, the beach ball does not ease gently to the surface. It erupts. The move that was suppressed for years is compressed into a very short and violent adjustment. The deeper question is why authorities keep reaching for tools like this in the first place. The pattern is not new. Ancient states debased their coins. Monarchs forced loans from merchants and subjects. Modern governments manipulate interest rates, and when pushed far enough, the entire yield curve. The methods change with technology and institutions. The underlying temptation remains the same. When debts are too high and growth too weak, those in power face a simple but brutal choice. They can acknowledge that the structure is unsustainable and accept defaults, restructurings, and painful adjustments. Or they can try to make the burden look lighter by changing the measuring stick, lowering yields by force, allowing inflation to nibble away the real value of obligations, or both. Yield curve control is a sophisticated way of choosing that second path. It allows governments to pretend that immense debts are harmless because the interest cost appears low and under control. History gives the same answer many times over. You can command statistics. You can command the shape of a curve. You can command the language used in official statements. But you cannot command trust indefinitely. When enough savers realize that the safe asset in their portfolio is being quietly manipulated against their interests, they begin to look for an exit. They seek refuge in real assets, alternative stores of value, or different currencies. When that migration reaches critical mass, the illusion of control unravels quickly. In a world where central banks have both the tools, and at times, backing to try to command the entire structure of interest rates, you are left with a choice. You can take everything at face value, assuming yields always reflect pure market forces, or you can view them as a mixture of genuine information and deliberate intervention. Awareness does not mean panic. It means recognizing that risk-free assets can be subject to very risky policies, and that extreme stability in markets often comes at a cost that is only visible later. When you see enormous debt, ultra-low yields, and policymakers insisting that everything is sustainable if rates just stay where they are, you are not looking at a free market miracle. You are looking at a trade-off. Comfort now versus volatility later, cheap borrowing today versus honest price discovery tomorrow. Every generation thinks it has finally figured out how to tame the cycle, flatten risk, and manage debt without the painful consequences that haunted earlier eras. Every generation eventually discovers that the fundamentals of trust, value, and human behavior have not changed nearly as much as the tools used to disguise them. So yes, interest rates can be commanded, for a while on paper, by decree. But the true cost of money, the real price of time, risk, and trust, always finds its way back into view. And when it does, the line on a chart that once looked like proof of control is revealed for what it really was, a temporary drawing over something much older and much stronger. If this gives you a new perspective, subscribe. History has the answers. I'll show you where to look.